Hello, my name is Carlos Lopez, Managing Director of Creative Planning. My goal is to guide you from that which is keeping you from financial success. We'll do this by educating you through short educational videos that get right to the point so that you can take actionable next steps. Today's video is on market volatility, so let's get started. When we experience market volatility, it's very common to want to give into emotion or take actions that we think will preserve our wealth. The impulse might be to pull out of the market or not invest that cash that we have sitting on the sidelines and just wait for better times. But I want to share why I think this isn't the right approach, and in most circumstances, it can in fact actually help you erode wealth if the exit is based purely on emotion. So I'd like to use some important historical analogs that'll give us a sense for today's volatility and provide you with some confidence for our future. So over the past 50 years, the markets have seen substantial setbacks. As you think about your investments and your wealth, take a look at this chart. What year would you say you started investing? If you're retired, when did you hit your peak earnings and savings years? Which year would you say your portfolio was worth the most? Which of these market downturns caused you the most concern? As the chart shows, $1 invested in 1970 would be worth about $98 at the peak of its market at the end of 2021. But along the way, investors were exposed to many periods of volatility. As you look at the green line representing the large cap stocks globally, you can see that in every instance that the market fell, the markets recovered and they went on to new highs. Each market recession was followed by expansion, every bear market was followed by a bull, and every market downturn was followed by new market highs, every single time. The stock market as measured by the S&P 500 over the last 42 years is up about 79% of the time and negative about 21% of the time. This is since 1980. So odds favor the investor with the long-term outlook. Now in 2022, we're experiencing a bear market. That's defined as a decline greater than 20% from the previous high. These are less frequent periods in the market, with one occurring about every 5 or 7 years or so. Now this is different than what's known as a market correction, which is a decline of only 10% or more, which can happen about every 12 months. Now the last bear market was in 2020 during COVID, and the prior one to that was in 2018. But markets don't stay down forever. They eventually recover and they move on to new highs. What we can't know is the duration or the severity of these bear markets. What we do know with a high degree of confidence is that this period of volatility will pass. Now, if you review this chart, any of the blue bars that are above that 0% line are positive rates of return in any one year. Below that 0% line is a negative return in that particular year. But in 100% of these years, if you look at the red lines, these are the intra-year declines, the low points of the market for each of these years. And you can see that while all of these years have an intra-year low, most of them actually finished positive. If you look at 2022 as an example of the last bear market, it reached a low point of negative 34%, which is about the average decline in a bear market. Now, we haven't hit this level of decline in 2022, and no one can predict where this year will end. But let's continue our journey over history and continue our examination of the markets. Remember, the market favors a long-term and patient investor and can punish an emotional and short-sighted one. Let's look at a chart that I believe will explain where we are and where we may go in the future. I like to refer to this as regression to the mean. These are the market returns as measured by the S&P 500 and its predecessor over the last 197 years. And each of those years of the market is represented by a little tile or brick that you can see in this chart. Now, the rough average of the market's return each year is about 10% per year over this time period. Now, I'm showing this with the dark, bold, black vertical line in the middle. I'll indicate that here with this little drawing. Now, about 45% of the time over the last 197 years, the markets have fallen into these two columns here, which we'd say is one standard deviation from the mean. They're both positive columns, and we typically find ourselves here about 45% of the time. About 75% of the time, we find ourselves within two standard deviations of that mean, and about 90% of the time, we find ourselves within 3 standard deviations of this mean. On a less frequent basis, you would see a 4th standard deviation event. Here you see 2022's low point at negative 23% indicated here. And even more rare is a fifth standard deviation, which we last saw in 2008 during the financial crisis, and prior to that was in the Great Recession back in 1937. Where markets pull back to a fourth or fifth standard deviation event, it's like someone pulling back as far as they can on a rubber band in terms of performance, and upon its release, you can have a regression to the mean, and beyond, quite frankly. In many cases, this snapback can happen very rapidly. That would award long-term investors who not only held on, but took advantage of the recent decline to harvest losses and opportunistically rebalance to buy into the market during these declines. As I mentioned, a period like the one we find ourselves today, known as a bear market, while not rare, don't happen too often, but when they do, they can often surprise the less experienced investor. Bear markets are normal, they happen with some frequency, and most importantly for investors to remember, they are temporary. So let's look at this chart that shows the last 17 bear markets going all the way back to 1926. In every case, 100% of the time, the markets recovered and went on to new highs, only to give way to another downturn or recession, and then recovery cycles started anew. So if you look closely at this chart, many of the subsequent bull markets last many years with cumulative net gains that were absolutely staggering. So what should you do if you're invested today? Perhaps you're saving for retirement or college for your kids, or perhaps you're already retired and worried about your financial future. If you don't already have a competent advisor that has provided you with a written plan, contact us today. All of our clients have a written plan and a customized portfolio designed for them. Now with a plan, this can bring a high degree of confidence in what your investment should be doing for you over time. And your advisor can also review this plan with you to ensure it's still accomplishing what you need it to do. Now, once you have a plan in place, or assuming you already have a plan in place, it's important to stay invested during these volatile markets. Don't give way to emotion and don't sell into this volatility. Your losses, if you do that, will become permanent instead of temporary. Once you sell, you are out, and while it might feel good in the moment, you have likely just made a poor investment decision because the ensuing recovery, which could and often does happen rapidly, you're going to miss out on those early days of recovery, and just a few of those missed days of a market recovery can cost you greatly. Take a look at this chart of the S&P 500 over the past 30 years, during which if you missed just the best 25 days out of 11,000 days, your returns were cut nearly in half of what they could have been had you just stayed in. Now, more recent bear markets, such as the bear market shortly after 9/11, the 2008-2009 financial crisis, and COVID, you can see how quickly markets can recover. Once the markets hit their bottom, the subsequent short-term market recovery was substantial, and it occurred very quickly. This is why this is not the time to sell into this volatility. While we can't predict and we don't know if we've hit the bottom of this year's market, history lessons are very clear. Stay invested. Harvest losses, and if you have the opportunity, rebalance your portfolio opportunistically so as to buy into this decline. These actions will help you better your financial position when the eventual market recovery occurs. To understand this chart, just take a look at the last panel. It's showing the March 24th, 2020 bottom of the COVID decline, and you can see as soon as the markets hit bottom, within 1 month, they were up 25%, 3 months 40%, 6 months 46%, and after 1 year, 77%. Looking a little further back to 1926, we see here in the center panel that the cumulative returns of a stock market after a negative 20% decline is 22% after 1 year, 41% after 3 years, and 72% after 5 years. Now, many investors say this time and today it feels different. Inflation is high, the Fed is tightening faster than at any time in 1994, and we have an unpredictable global recession that we're facing and an escalating war in Ukraine. If this is causing you concern and anxiety and you feel you may want to sell out of the market, before you do, we encourage you to call your advisor. And if you don't have one, please reach out to us at Creative Planning. We'll review your goals, your current portfolio. We'll run an analysis on your retirement and your other financial goals to help you have the confidence you need to make the right decisions regarding your portfolio. If rebalancing your portfolio makes sense, we'll do this in collaboration with you together to help you find the portfolio that will meet your goals and keep you from making what could be a costly financial mistake by going to cash. Thank you for joining me today. My name is Carlos Lopez. See you next time.